Welcome to episode 5 of Meeting of the Minds, the show devoted to the growing world of independent sponsorship and deal-by-deal private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's interview is with Jay Fuquay of Trinity Investors. Trinity started as an independent sponsor, but today their business model involves partnering with other sponsors to help with the capital raising. So a broad perspective on the market here. Before we start the interview with Jay, let's share a few of our thoughts. Guys, Max, what grabbed you? What should listeners be paying attention to?
One thing that I found to be very interesting was Jay talking about how he and Trinity screen for the independent sponsors that they invest in. And, as he described, as we all know, the independent sponsor space has really grown a lot over the last decade or so. And it's much different now than it was when many of us were kind of first starting out in this space, either as sponsors or service providers in the space. But, because there's so many sponsors out there, Jay and Trinity have really narrowed down what they're looking for. And the first thing he mentioned was they're looking for teams and not solo players. So, that's interesting. And he mentioned that a lot of the solo shops, potentially they don't have the bandwidth to, stay in the investments for the long haul. They don't have the strategic group and administrative capabilities that the team has. They're also looking for a track record, which makes sense. And all of this makes sense for us as well to listen to as Minds Capital partners. So they're looking for a history of success, but they also want to make sure that the sponsor was involved in the success and that they didn't just get lucky. I thought that was a really interesting, cool point. In diligence, they're actually contacting other capital providers in past deals of the sponsor to see, was the sponsor involved in the success or did he just buy it right and ride it? So that was cool and helpful for me. They want sector expertise. So they want somebody with a deep background in the space that the deal is. So they don't want you branching out into something you're not an expert in. And then of course, something that we want as well, as well as all the other things we just mentioned. They want the sponsor to have some skin in the game financially. So a great list of characteristics that they're looking for with the sponsors that they're investing in. There's a lot more to talk about, though.
His point about diligencing the sponsors to make sure that if they can tell a good story about past deals, that they actually impacted the good outcome. It just goes to show how in this space, there are a lot of good outcomes that maybe aren't always to the credit of the sponsor. It was just there was luck involved, or the market broke the right way for them. So the fact that they might see a great outcome on a sponsor's resume and diligence the great outcome, actually press on it to make sure that the sponsor provided, actually it was something of the sponsor's doing, I think it speaks to that. It was pretty interesting. Nicholas, what about you? What did you think?
Before I jump into that, I'm actually curious, Max, as a QFE provider, you've worked with countless sponsors over the years. So how does that list of criteria match what you see as the success factors?
The best sponsors that we've seen and sometimes on the side invested in, they were teams. And they typically had at least a sort of a private equity partner and then an operating partner that had experience in the industry. So that was key. You could tell the guys that had done it before, and this wasn't their first deal as an independent sponsor or even as a searcher. That's kind of obviously a stepping stone to becoming an independent sponsor for some folks. So the ones that had done it before, they know what to look for in diligence. They're a little bit more streamlined. There's less hand holding. You can tell that they've done it before. When they're aligned with their experience with the industry that they're investing in, it comes across as well in diligence. They know what to ask for. They're not kind of going down paths that aren't that important, getting hung up on details that are not key to the deal. So, it totally aligns. But the part to me that stood out the most was exactly what Will was kind of expanding on there, that, they're then going a step further with Trinity and with Jay to make sure the sponsor had some influence on the success of the deal. That's not something that I've really thought about, but something that I think we should absolutely be thinking about at Minds Capital.
All right. I really enjoyed hearing Jay's perspectives on retail investors versus institutional capital. He's really an expert on this topic, and of course it's important for every sponsor out there, but also for us in Minds Capital at the fund level. And so he asserts that there's effectively an infinite number of people who are able to pay or invest 100K or write a 100K check for any given investment out there. But that if you are looking for people who can write a 500K or $1 million check, that you really, really limit your options then, or the pool of candidates is so much smaller. And of course, the benefit of retail investors is that in general, you can charge higher fees because they tend to have less access and maybe less sophistication versus professional investors. All of this made sense to me. However, that said, and he points this out, raising capital from retail investors is not something you see a lot in the independent sponsor space, because independent sponsors, they have a deal under LOI. They have maybe 60 days to complete the equity raise. And if you're going to raise 10 million from people with 100K, and then you're going to need 100 of them. So you simply don't have time for it as a sponsor. And so that's a differentiator for someone who has more time than what an independent sponsor does.
Well, you really need an infrastructure to raise so many small checks, which is precisely what Trinity has built. So, I mean, you can,
right.
The value proposition that they offer is pretty clear. I'll go back to one thing that grabbed me about, again, their criteria for independent sponsors that they choose to work with. He was opinionated overall. I loved that he gave very direct answers to a lot of our questions. And one of them was on this question of can sponsors be the CEO of their own deal, the operators in their own deals? And he was emphatic that no, the model requires some scalability, and you can't scale yourself if you're CEO of one of the businesses that you acquire. We're not all Elon Musk, as he said. It struck me because coming from acquiring Minds land, almost all of my guests are the operators of their businesses. So that's my orientation. But also at Minds, we have seen a couple of instances where there was a searcher, so somebody maybe not looking to do as large a deal as an independent sponsor would, but in their search found a deal that was too large for kind of self-funded structure, too large for SBA, and kind of therefore pivoted mid-search to become a sponsor or to rethink how they were going to take down this business, and it ended up looking like a sponsor deal. But what remained in those instances was that searcher still was going to be the CEO. They were going to get into that business and run it, and are now doing that in the cases that I'm thinking of. So if he's so kind of dogmatic on this point that is not the model, I wonder where those people should go. What is the right approach for somebody who's not a searcher, so bigger deal than SBA, independent sponsor size deal, but wants to be the operator CEO of that business? How do they raise money from that for a deal like that from a Trinity? Because Trinity wouldn't do it. So it's a rhetorical question, but it piqued my interest. Great, guys. Well, let's get to the interview with Jay Fuquay of Trinity Investors, Meeting of the Minds, episode 5. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Jay Fuquay was one of the first employees at Trinity Private Equity Group in Southlake, Texas. Today, he's the executive vice president and heir apparent to the founders. Trinity has been a pioneer in the independent sponsor space for 15 years. They've deployed hundreds of millions into lower middle market private equity deals and multifamily real estate investments. A few years ago, Trinity stopped sourcing their own deals as sponsors in order to focus fully on partnering with third-party, other independent sponsors and becoming their equity arm. So Trinity's model has really evolved here and innovated into a place where today they're raising equity for independent sponsor deals from their network of high net worth retail investors. Jay's here to tell us more about Trinity, about this model, and where he sees the independent sponsor space going this year and beyond. Jay Fuquay, welcome to Meeting of the Minds.
Thanks, guys. Really happy to be here. I'm joining this afternoon from what I normally say is sunny and beautiful South Lake, Texas, although today it's actually snowing. We've seen more snow today than we see in a normal year. So a little bit unusual, but I'm happy to be here at Trinity headquarters speaking to you guys.
Well, we thank you for making it happen, Jay. What is more snow than you get in a year in Dallas? Like a couple inches?
It's about 2 inches. Yeah, I bet we're in the 2 to 3 inches just since this morning, but big, nice, fluffy snowflakes. And look forward to playing in the snow later this afternoon with my daughter, which is a once every other year type thing.
Great. Well, we just got a big snowstorm on the East Coast, so I was doing some of that myself earlier this week. Great, Jay. Well, let's start the conversation by looking at an actual deal, a recent deal that you all have done or been involved in. We spoke offline about Project Maverick, and one in the aviation industry. Seemed like a good candidate. Why don't you kind of walk us through that from sourcing on?
Absolutely. That's a good starting point. And not only is it recent and fresh in everyone's memory and something we're very excited about, but it was a relatively typical kind of down the fairway structure for us. So I think it's applicable here to the conversation. Project Maverick, the underlying business, of course, is a manufacturer of aftermarket parts for military aircraft. So a little bit of a mouthful there, but they're making airplane parts exclusively for military aircraft. And these are replacement parts, right? That you're not getting from the OEM as part of the original plane. They all are subject to the original parts to replacement cycles, whether that's flight hours or time periods, and then they have to be replaced. Often the OEMs don't want to do that. The OEMs, like a Boeing, are focused on making entire airplanes and not making specific parts to replace things that have worn out or been through their useful lives. And so there's kind of a healthy, robust ecosystem of aftermarket part sources. And Project Maverick, the business we bought, is one of those. So there was a lot of interesting things to like about this business. Where should we begin?
Let's start with the sourcing. So how does an opportunity like this come to Trinity, and what is the sponsor looking for? How does that whole conversation begin?
In this particular case, there was an independent sponsor, and they, had this deal under control, right? Meaning, hey, I've got it under LOI. We've got an exclusivity period here. We're working in good faith on a purchase agreement and whatnot, with the seller. During that period of time, the independent sponsor was introduced to Trinity, right? They're looking for debt and they're looking for equity. Trinity, of course, could be the majority of the equity. Actually through a placement agent, effectively, right? There was a broker or a banker whose goal in life was to help connect this sponsor in the context of that deal to prospective capital partners. So there was an introduction that was made in this case.
Is that how you get a lot of deals from brokers?
No, I would say maybe a third, right? It's kind of a mixed bag of ways that we have been introduced to specific deals previously. Again, Trinity's world, deal flow means sponsor flow, right? We are trying to partner with independent sponsors who have deals under control. So if I get an outreach from a seller of a business or a banker and says, what do you think about this deal? I can't do anything with it, right? I need a sponsor to have already fleshed out a lot of the details, have a value creation plan they're excited about, have it under control, have the broad strokes of the capitalization coming together. And so given that, right, the way we normally are introduced to deals is through the independent sponsor that we're ultimately going to be partnering with. Sometimes we meet them at conferences like the Big McGuire Woods conference. Sometimes they're somebody that comes sort of organically through our pretty large network. Sometimes it's a broker introduction.
So You say deal flow means sponsor flow, which is actually very similar to how we think about things at Minds Capital. We invest minority equity into syndications done by independent sponsors. This is different from your model at Trinity Investors, right? Where you guys essentially become the equity arm in partnership with the sponsor. Can you just kind of flesh that out a little bit?
And that's a reasonable way to summarize it. The way I explain it is that every Trinity deal is a partnership between an independent sponsor who it will be their deal, right? They are controlling the board generally. They're leading the value creation plan. They are in the driver's seat. And Trinity is their capital partner. So it's sort of correct to say we're sort of an extension of them in the context of this one deal, and we're the capital function, right? We also have seats on the board. We obviously also have resources and whatnot to help the business be successful. But the primary thing we're bringing is usually a majority of the equity in transactions like Maverick.
Thank you for laying that out. So when a sponsor gets under LOI with a deal, their dream outcome in most cases is to syndicate the equity from a host of smaller investors where none is large enough to truly influence the governance or the terms. Going with Trinity, if you guys become effectively their equity arm and you do the majority, is that a little bit of a backup option that they go to if they've already given up on raising all the equity themselves? Or what are the dynamics that lead them into your arms?
I like to think of us in that case as a little bit of the best of both worlds, in that we will handle what is a large scale syndication, right? So for Project Maverick, the equity requirement was in the $40 million range. Trinity did a majority of that through our high net worth investor network. So you get, again, a little bit of the best worlds. Trinity showing up with a majority of the equity, which solves the majority of the equity raising side of the equation. But we are getting potentially a universe that has a little more alignment between us and the independent sponsor and isn't beholden to kind of a specific whale investor or other kind of institutional person that could go left on you or maybe try to change terms or control the deal in the future.
And so I think this is the other big difference, right? So yes, they agree we need a partner to raise all the equity. In Project Maverick, pretty big deal in the independent sponsor world, a $40 million equity raise. And so they come to Trinity, but where many PE groups are that anchor investor and they'll try to negotiate terms and insert themselves into the deal, you guys actually don't have the funds committed up front, right? You syndicate them on behalf of the sponsor with your extensive network of retail investors, as you call it. So how does that work?
Yeah, correct. The sequencing here is we get introduced to the sponsor. We're going to do diligence on them and their expertise and background. We're going to do diligence on the underlying business. You know, do we like the business model? You know, how healthy and resilient is their model and their prospects for the future? So two-pronged diligence. You know, then if we like the opportunity, we're going to issue a term sheet to the independent sponsor for a majority of the equity. They're going to probably do some negotiation and hopefully we'll find a happy medium. And then we will go raise the money from our investor network at that point. So really, our money raising process is happening concurrent with the lender's process. They're doing their thing. We've got the other diligence work streams coming together as well, legal diligence, quality of earnings, et cetera. All of this stuff is happening in parallel with each other, you know, in the 60 to 90 days before kind of an ultimate closing.
And Jay, what are the actual mechanics then of raising the equity from your investors? I assume it starts with an email communication of some kind. What are the actual mechanics and steps there?
It does start with an email communication. Yes, there's an executive summary that goes out to a group of investors that, you know, we believe are good fits for this investment. You know, they need to be suitable, et cetera. Everyone we work with is an accredited investor. Most of them are QPs. That means qualified purchaser, which is sort of a step above accredited investor. But nevertheless, you need to know your client and you know their suitability. So that's the group that this opportunity would go to. Then they get an executive summary that's pretty standard teaser, you know, 4 or 5 pages. If they like what they see there, they can kind of, raise their hand and opt in, and then they'll get more information. There'll be a PPM with a whole bunch of more analysis and explanation and risk factors and whatnot, forecasts. We do a webinar with the sponsor where we explain in English why we like this particular opportunity. And then there's usually an FAQ document. And then there's kind of a deadline where people are going to log on to our website or our portal and request to participate in an allocation.
So how come you are positioned to be more successful at doing this? So if we go back to Project Maverick, what you're outlining here is a very common fundraising process for any independent sponsor deal. Why would they outsource that work to you guys at Trinity in the last deal of Maverick, for instance?
I think the short answer is it's hard. And if you want to do it at a certain scale, which means deals that are, large enough, or, multiple deals over and over, ideally that are also sort of large, you may start to feel like all you do is raise money and manage investors, right? And you don't have time to focus on what you're really good at, the sponsor, which is hopefully sourcing proprietary deals that are exciting, executing value creation plans, growing your platforms. There's just a lot that goes on in the capital raising side. And what we found is there's enough good groups out there who want to stick in their swim lane, which is the value creation plan or growing a platform, and let us focus on what we do best, which is the capital raising side.
And you are uniquely positioned here because you have a database of investors who are ready to jump on whatever vetted deals you send their way.
The short answer is yes. I think we're uniquely positioned for several reasons. Trinity was founded by entrepreneurs, people who had run and grown private businesses. Sanjay Chandra, who's one of our key principals, grew a leather furniture manufacturing business to be very large. So we have manufacturing experience. We also have several other investments that touch the aviation industry. So we have good experience. We've also been an independent sponsor, right? At the outset, you referenced how this pivot or change happened 4 or 5 years ago, where we used to be the sponsors, and we've now pivoted to just being more of like capital partners to independent sponsors, now that there's a strong, robust community of independent sponsors out there. So I think we have those things to our advantage as well. And then we also created what I think is a pretty unique and differentiated fundraising engine. I did want to double click on aspects of what makes the fundraising engine special, if you think that's a good place to go next. What I want to make clear is that what Trinity is not a pure sales engine or crowdfunding website or online marketplace or something like that, right? What we have, which is attractive from the perspective of our investors, is a deal sourcing engine, right? We get good deal flow on both the real estate and the private equity side from a variety of sources. We have a big team of financial analysts called the investments team that really represents, the funneling process, right? We have opportunities coming in the top of the funnel, and we're working hard to filter those down to what we think are the best, most investable opportunities. And then we have an investment committee, right? And so the best deals get pitched kind of by a deal team to the investment committee, and then the investment committee scrutinizes them, asks a lot of questions, kind of goes around in circles for a little bit with Q&A. Ultimately, if you make it through that meat grinder, the question is, are the people at Trinity ready to invest between 5 and 10% of the dollars that a transaction needs, right? So there is a principal investing family office aspect to Trinity where we are all eating our own cooking. We're putting our own money in these deals. And if all these conditions are true, right, it makes it through the meat grinder and the investment committee process, and there's the requisite amount of interest at Trinity to fill 5 to 10% of this deal ourselves, then we can launch it to the investor universe that we have. Onto the investor universe, right? Today, it's somewhere between 3,000 and 4,000 high net worth individuals. But to clarify, these are what I would call the mass affluent or the millionaire next door or the everyday millionaire, right? There are some doctors and bankers and lawyers, but also a lot of entrepreneurs who have grown, their personal balance sheets to have something like $5 to $25 million of investable assets, right? So they're wealthy, successful people, but not ultra high net worth individuals who are going to stand up a family office and put $10 million into a specific deal. What works better for them is if they can put between $100,000 and $250,000 in a specific deal and then do another one and then do another one and build a portfolio of alternative investments through Trinity in that way.
When you promote a deal, Jay, you mentioned funnel earlier. There's kind of a funnel of conversion on a deal by deal basis as well. You must be very certain when you work with a sponsor that you can satisfy the equity needs. So how do you get that certainty that you're going to be able to raise the money from your investor network that you need to, the 40 million in the case of Project Maverick?
Yeah, well, that's the other litmus test, right? Is, are the people at Trinity excited about investing in this deal? And then is there enough enthusiasm across the group to know that we can go, sell this to our investors? And we're not going to issue a term sheet if the answer to those questions isn't yes, right? So we've never left somebody at the altar because we couldn't raise the money, right? And then had a deal blow up for that reason. But we have to be very judicious about issuing term sheets, knowing that we're absolutely going to be good for the money. Trinity's primary job, from the perspective of a sponsor partner, is to show up with the money that we said we would on the day the deal needs it. So we need to make sure that we're going to be able to deliver there. And, if we're liking a deal, but uncertain if we can meet that commitment, then we're not going to issue the term sheet.
Going back to your millionaire next door, thanks for describing who this is. This is your doctor and lawyer who has some assets. In general, how much do you see them wanting to expose towards alternative assets like this out of their total investable portfolio?
Yeah, that's a good question. And to clarify, that when you're kind of maybe a young person growing up and you're told about, the high salary jobs or doctor and lawyer, right? That's probably what I thought as well when I started at Trinity. And okay, we deal with high net worth individuals. There must be a lot of those folks. And I bet those folks are between 15 and 18% of our investor base, right? So they're a minority piece for sure. The balance of the investors are just from all walks, right? It's really hard to paint them as any particular occupation or background. Usually they're entrepreneurial in some way and have, earned ownership of something that grew in value over time, right? Through lots of hard work and good fortune and other things on their part. So generally our investor base is pretty entrepreneurial. So I think they're inclined to invest in this sort of thing more than, some sort of baseline, or probably more than a normal doctor or lawyer, because they're just entrepreneurs and they've seen how much wealth you can create by being an entrepreneur, but they can't be in three places at once. So they'd like to put their money into something like Trinity, where there's other entrepreneurs who are going to work hard on behalf of their money. So that was a little bit of a tangent, but it's really hard to paint our investor base with any kind of specific brush. They're very diverse, but don't all originate from the classic high salary occupations. And
so how have you built this database of mass affluent millionaires next door?
Yeah, so that was the, there's an expression that's the 10-year overnight success, right? When we, launch a new deal and we send out a teaser, and then within 60 days, we've raised $40 million. It looks easy, but it was not easy to get to that point, right? Dan and Sanjay, Trinity's founders, took a lot of startup risk and started very small about 20 years ago. And it was a whole lot of work and effort to raise $2 or $3 million. And then those deals go well, and then you sell them and send money back, and the pie grows a little bit, right? The investors have more liquidity than they did before. They tell their friends, you get referrals. So really there was just a sort of iterative process of pretty good outcomes over, at this point, 2 decades, to be able to get to that kind of critical mass of these high net worth individuals.
But how often do you need to communicate with a warm lead in your database? Or how often do you need to send them investment opportunities so that they stay warm?
It's case by case, right? And again, this is all through the lens of sort of appropriateness per investor. Trinity is regulated by both FINRA and the SEC. We have audits and all kinds of work and effort that's gone into the compliance function. So we're needing to, one, make sure always that we're adhering to all those regulations and that what we're doing is appropriate on a per investor basis. We tend to do something like 10 to 20 individual deals per year, right? And in certain times, it might be more than that. In maybe tougher markets like what we're in today, it's probably less than that. But we do have a kind of a steady stream of things for individuals to look at, which I do think this style of investor likes. They can pick and choose, basically, right? They are part of our database, but there's no membership fee. There's no blind pool fund element to anything that we do. They're going to see opportunities, and then they're either going to say, this one is interesting, I might want to learn more, and then maybe they invest, or this one's not for me, I'll pass. And then they can pass on 10 in a row, right? They don't get kicked out or voted off the island, right? They're going to be allowed to build their portfolio with the investment opportunities that appeal to them.
But if you're an independent sponsor and you've done 3 deals now, and you have a handful or a dozen investors that have worked with you repeatedly, I mean, the holy grail is to build a database like the one you're talking about, of, as we started the conversation, of a lot of smaller investors who can't influence the governance or the terms, but are happy to participate. So how do you go about creating that database or building it? And, what are the steps? I'm sure there must be a business development playbook here.
Yes and no, right? There's no secret sauce or no magic fairy dust. It really is one investor at a time that you earn through trust and good outcomes. And we did that for 20 years, approximately, right? Something like that. And then it's grown and grown and grown. However, we do have a pretty defined swim lane, right? Or strike zone, which is this individual that can put something like $100,000 into a private deal, not worry about liquidity. They don't need that money to send their kids to college, things like that. And then they need diversification. So they need to be able to do that kind of at least 3 to 8 times. That's sort of what we say, right? You should plan on doing at least 3 to 8 Trinity investments. So 100K a deal, 250K a deal. That's really like right where our sweet spot is. Getting back to maybe other models or holy grails that independent sponsors are after, if you have a list of 10 or 12 investors, I mean, if they're only doing 100K each, that's $1 million or $2 million, right? And so you really can't, buy very much with $1 million or $2 million of equity. I suggest generally that people play in spaces above that. It's just probably going to produce better outcomes. So if you're still talking about a relatively tight-knit group of people and you're needing them instead to put 500K or $1 million or $1 million in a specific deal, part of the issue that we found is if someone is in a position to write a series or sequence of $500 to $1,000 to $1 million checks, they're closer to a professional investor, and over time will start, behaving like a professional investor, which means they want to set terms, they want control. They want the deal to evolve over time to reflect the level of their investment, etc.
And so this is the chicken and egg, right? Because as a sponsor, you need to raise 5 million or 40 in your case, but let's call it 5-7 million for your deal. And you just simply don't have time or capacity to raise it from 70 different 100K investors. So starting on that millionaire next door avenue on any given deal is just not practical. And so you're looking then for the guys with 500K or $1 million. So smaller family offices or kind of experienced investors in the space. And that's how you build your cap table. But that leaves you somewhat vulnerable for future deals in that you don't have this massive database. So this is very unique that Trinity has built this.
Thank you. I agree. And that's our secret sauce, right? With this style that you just referenced before, chasing the 500s to 1 millions, you could become beholden to a specific individual, right? Depending on, the specifics there. In the Trinity world, Sanjay is the largest individual investor. So that's positive, right? He's a person at Trinity. He's the largest investor, and he's somewhere between 1% and 2% of everything, right? So we're not beholden to any specific whale. If certain of our investors run out of liquidity or go through, death, disability, divorce, these sort of things that really change your mindset, it's not a problem, right? We have a big diversified base of high net worth individuals. The other thing I'll say is the 500K guy or the million guy, they're out there, but there's way, way, way more of the 100K guys. In fact, there's an unlimited number effectively, right? That's kind of the attitude that we like to have is if you go and walk around the mall, it's not true that everyone has $100,000 to put in a private investment, but there is an effectively unlimited number of those people out there if you work hard enough to find them. The universe of 500 and a million people is much, much smaller. And so you're in a more, a bigger pond, if you will, if you're hunting for the 100K checks.
Jay, as you think about scaling the model further, is there more of a bottleneck on the supply side of capital, finding more people to add to your investor network, or on the demand side, finding more sponsors, more deals to do? I mean, in some sense, you're a platform, you're a marketplace.
Yeah, absolutely. With the caveats that, we're putting our own money into these deals. We have an underwriting function, right? Some of the things that are pure marketplaces distance from that sort of thing, right? They're saying, we're not an investor. We're not making recommendations. We're not opining. We're just a marketplace. So we have a marketplace element in that we're sort of matching sponsors with investors. But, most of the investors are coming in because Trinity has vetted and underwritten a deal and is investing in it, ourselves.
So on the two sides of the marketplace, understanding that it's not really a marketplace, where do you see the bigger bottleneck? Deal flow or investors?
No, it ebbs and flows. And the problem is, and I think this is universal, it ebbs and flows inversely, right? If the capital is very easy to raise generally, right, in an easier money raising environment, then the good deals are going to be harder to find, right? In a situation where there's generally less equity capital available, it's going to be easier to get to the deals and then harder to raise the money. So I'm positive that there's a tension there, and it's sort of inversely related. Today, I would say we are generally in an environment where it is harder to raise equity than a baseline.
Why is it harder today?
I think just generally across the private investing universe, there are less sales happening, right? Fewer people are selling investments that they've made, and therefore there's less liquidity available for new investments, right? These are all illiquid investments generally. Now I'm talking real estate and I'm talking the private equity deals. I think if you go to McGuire Woods or whoever has kind of a bird's eye view, they'll say over the last 5 years, we've done way more acquisitions than we have sales, right? And that means there's a lot of capital tied up in deals and less capital available to make investments. And so I think, on a scale of 1 to 10, I think we're somewhere between a 7 and an 8 in terms of capital being kind of in short supply. We're on that side of the coin currently.
Just because of the lack of exits in the last couple of years is not providing liquidity to the market, and also probably making the investment class less compelling than it would have been if it was super liquid, and a lot of good exits recently.
Exactly. Also, the interest rates are higher, right, which makes it more difficult to do a leverage buyout or borrow money. Also, the risk-free alternative, right? I'm going to put my money in a bank and it's going to earn 5%, or I'm going to put it in the stock market, which has done very well over the last 2 years. Those are pretty appealing options today, right? Or they seem appealing. And so the substitute almost for what you're offering is a little bit better than it has been, if you go back 5 years where interest rates were zero and there's nothing to do with your money.
Going back a little bit to the millionaire next door, if you don't mind. So Will in particular dabbles a lot in the self-funded search world, where the cap tables are often syndicated by raising capital from, your friends and family network. They're not typically raising a ton of equity. We're looking at 6-digit amount, maybe a little bit into the 7 digits. So they're able to find 10 or 12 investors with $75K each, and that's their full equity stack. And notoriously, they get very good terms, self-funded searchers. Is there a link here between raising money from your less sophisticated investor and getting good terms? And if so, how are you guys taking advantage of that?
I wouldn't say we're taking advantage of anyone. But what we are doing is creating a pretty large format syndication, right? So for Project Maverick, with the $40 million, I don't know what the biggest investor is, but he's like 1%, right? And so even with sophisticated investors, which we have in Project Maverick, there were some people that I would characterize as very sophisticated professional investors. They may look at the terms and say, well, these terms are more favorable for the GP side than I'm used to.
So what were the terms in Project Maverick for the GP?
Yeah, well, generally, there's probably just a relatively fuller fee basket, both on the front end and potentially as a monitoring fee than a baseline, right?
And so the three normal buckets are closing fee, management fee, and carry.
And exactly.
Typically, we see 1% to 2% closing fee, 20% plus carry, and 5% EBITDA management fee. Are you saying your fees are elevated from that?
I would say that the combined fees, right? Because there's really two mouths to feed here when Trinity is involved, right? There's an independent sponsor who, yes, usually wants a 2% of enterprise value upfront fee, which we're supportive of. Then there's going to be a fee to Trinity, right? So that creates an above market front end fee load. Then usually the management fee is not above market. We see 5 to 6% of EBITDA in an aggregate basis, most commonly. And then, yes, there's a promote structure of some kind on the back end. And usually the promotes in this sort of two-party world are larger than 20%.
And where I'm getting to is, do you think an independent sponsor who was successful in raising money from retail, as you call it, versus the more sophisticated investors who are more in the 7 digits, do you think there is an opening there that they could in fact get significantly better terms if they do that on a standalone basis or with you? Is that like a systemic way that it's cheaper capital?
Yes, I think generally, if you're going to go to one capital source, or you're going to put the work and effort into raising equity from 70 underlying individuals, your economics will be better with the 70 versus the 1. And that's an extreme example, but if it's 3 parties versus 70 or 100, you're likely going to do better with the 100 or the 70.
Yeah, that makes sense. So the more fragmented your capital base is, the better you can control the terms.
Yeah, the way I would think of it is, if you're doing a biggish deal, let's say it's something that needs 20 million of equity, and you're going to 1 to 3 check writers, those are beefy equity checks, right? 10-ish million each. That entity is going to want to pay wholesale, right, for the money, which in my world, wholesale is, I'm mostly talking about the promote on the back end, 20 points, right? And it's usually 20 points after some hurdle rate, right? Once you have done this for me, like doubled my money, you can have 20 points of everything thereafter. But 20 is a industry standard promote level, but that's actually like the wholesale price, right? It's for someone that writes a $10 million check. If you're someone that's writing a $100,000 check, you're going to pay closer to retail, which just means, it might mean 30 points, or it could even mean 40, right? And so it's just more promote on the back end generally, and kind of a retail versus wholesale conversation.
And are those more attractive terms really the key differentiator? I mean, is that really what is kind of the first thing that draws in a sponsor to work with Trinity? Because those are much better terms.
Yeah, they're much better terms. But keep in mind, when I quote like a big promote number, it's still going to be split between Trinity and the independent sponsor, right? There are 2 mouths to feed here. So generally speaking, I think independent sponsors that we work with can do somewhat better on the promote side than they could from a different source. The other thing is that Trinity needs the independent sponsor, right? It's a symbiotic relationship. We're going to let them drive the deal. They're the subject matter experts. They're going to execute the value creation plan. We have a financial disincentive to get super involved as long as things are on track, right? I've heard stories of independent sponsors who become sort of beholden to one capital partner, and over time, the relationship evolves, and they sort of just feel like they're working for that party, for a fee. And if that party wakes up on the wrong side of the bed or changes their mind or does a left turn, you can feel like, hey, I'm getting pushed to the corner and they're going to force a sale, or they're going to do something that I otherwise wouldn't do. Or they're just trying to make it their deal and take over, right? Trinity just isn't set up to work that way, right? We have a whole bunch of deals that we're involved in, and it requires the sponsor to execute and do a good job, and they are a central pillar of our business model, right? Which isn't always the case, depending on who you're dealing with.
Have you ever seen a sponsor charge different rates within the same deal? So, hey, we raised 40 million of equity. We have two anchors who, yes, you get your 20% carry, but the rest of you are retail, so you're going to have to pay 35 or 40% carry. Does that happen, or do you have to give the same terms always to everyone?
Nothing is an absolute. So you don't have to give everyone the same terms always, right? It's case by case, right? If, for example, there's a deal that needs 40 million of equity and Trinity is going to do 30 of it and 10 is going to come from somewhere else, there's a chance the 10 is going to get different treatment than the 30. And that can be handled in a variety of ways, right?
Segueing a little bit here, you guys know a lot of independent sponsors, but you build new relationships all the time too. You mentioned going to the McGuire Woods conference. How do you know which independent sponsors to talk to? Because when you register, you're going to be flooded as an equity provider by people who want to chat with you. How do you filter?
Yeah, good question, which kind of boils down to, Trinity, who do you look at or look for as an independent sponsor partner? And, as we've grown, we want to partner with independent sponsors that have kind of 3 or 4 key pillars, right? One, it's generally multiple people, right? I know everyone has to start somewhere, but we really just can't get comfortable, partnering with a one-man band or someone that's truly just working out of the trunk of their car, right? Who has a deal tied up in some way. The best way is to have, 4 to 6 key people that are all experienced and can divide and conquer. I don't want the key person risk where, I'm investing with Will and Will's my guy, but then Will gets hit by the beer truck and now I got nothing, right? I need a little bit of safety and backstop there in the form of a healthy partnership that's endured for some number of years, right? So if I'm creating the perfect independent sponsor, they would have 4 to 6 experienced, professionals that have been together under the same flag for, 10 years. That would be ideal. So some mix of those factors is good. You also need, or you prefer, or we look for someone with a nice portfolio, right? Is it their first deal? Well, that's difficult to get comfortable with. Is it their 18th deal? That's a lot better, right? And understanding that everyone has to start somewhere. We still prefer more experience to less. I think that's pretty intuitive. Also, if you've been in the game long enough, what is your track record? Tell me about the realized outcomes that your equity investors and your other deals have enjoyed. And we're going to sort of scrutinize that and make sure that it's, true and correct. We're also going to try to do kind of an attribution analysis that says, did you, Mr. Independent Sponsor, create this great outcome that you're propping up, or were you sort of along for the ride, or did you just get lucky, right? And, everyone enjoys good luck. That's okay. But we're going to try to get to the heart of, is this person someone, or this group someone or something that creates value in the context of these platforms? Also, what sort of investment are we talking about? If it's somebody that has primarily done healthcare deals, and then they're bringing us Project Maverick, which is an airplane parts manufacturer, that's not obviously a good fit. It doesn't mean that it's ruled out, because maybe they have an edge or an angle here, or they brought on a new person who knows everything about this. But we like to see some specialization. We like to see a track record. We like to see a critical mass of impressive people that we're investing behind. I think that's kind of the starting point.
Jay, given the number of years that Trinity's been at this, reflect a little bit on how you see the category of independent sponsors and the quality there. So over these last 5 years, there's going to be a higher quantity, presumably, of better independent sponsors, because there's more people who've been in the game longer and have more experience. On the other hand, of course, the space is growing, drawing in a lot of people who are just doing their first deal. So it's also noisier, and separating wheat from chaff maybe is more complicated than it once was. Reflect on on how you see this space and kind of quality of sponsors in this space, keeping in mind that all those people are listening and wanting to understand where they fit in the kind of hierarchy of quality.
Sure. Absolutely. The space has matured and grown and become a more robust kind of ecosystem over the last 5 to 10 years, which is a good thing. And then also before the next, set of comments, not trying to throw stones at anybody or their approach, and also acknowledging again that everyone has to start somewhere, right? But what I really see across the spectrum of independent sponsors today is on one end of the spectrum is what I would call just a pure promoter, right? It's sometimes just kind of a deal Yahoo who's trying to get something under control and figure out how to capitalize it and earn a piece of it, right? And it's all upside, and I'm actually not accountable for anything because I've got my equity and my debt and the management team, and I've got a promoter, right? Generally, that's kind of what we're going to lean away from, right? The pure promoter, right? What we want is a impressive, tenured, experienced group of people who understand that they are accountable for the investment outcome that they're leading us into, right? Things don't always go perfect. We understand that, but they are not just trying to capitalize the deal and hope that things go well, right? They are putting a lot of work and effort in up front and then realizing that that is not the finish line, right? That's some version of the 50-yard line or something like that. The name of the game is how to create value in these platforms. And that's something that's hard and difficult, but it's something that they're accountable to us for, right? Does that make sense? Sort of the difference in philosophy there. Yeah.
Yeah.
The other thing, it's central. The independent sponsor needs to come up with a co-investment for every deal that we're doing, right? So we've been using an easy round number, which is Project Maverick needed 40 million of equity. And that's where Trinity came in. Well, we didn't actually provide 100% of the equity. We provided a majority of the equity. And the independent sponsor needed to come up with something like a 10% co-investment, right? Which is their own money, their father-in-law's money, their mother's money, whatever. They can syndicate some of it. Some of it needs to be their own. That's a critical piece as well. So I guess that's a filtering or a litmus test as well. Is do you have the wherewithal to fund a meaningful co-investment alongside us?
Jay, you had talked about in our pre-call that sponsor as CEO, putting him or herself in as CEO is a non-starter for you. On the other hand, I also just heard you say that a very clear value creation plan, somebody with a plan who's going to get their hands dirty, but I guess at arm's length, is really important to you. So kind of how do you see your ideal for sponsors' involvement in the business? And maybe start by saying how you're anti them being CEO.
Yeah. And again, let's get the context right. Because if you're a search funder or an entrepreneur through acquisition, right, you're sort of explicitly wanting to be the CEO of a business.
Right.
So that's one category. It's really not what we're talking about here. An independent sponsor, in my definition of the word, who is saying, I'm going to be the CEO, and that's just, pardon my French, fucked up. That's not how this world is supposed to work, right? The independent sponsor should be on the board, potentially the chairman of the board, and the CEO of the business reports to the board and is held accountable by the board and can be fired by the board, right? So the way that this whole thing is right-sized, generally in our world, is the independent sponsor is 3 of 5 board members. Maybe Trinity is one. Maybe the CEO is also one. But there's a different person who's the CEO and is professional, experienced at leading companies like what we're talking about, right? We need someone with, usually decades of experience in the aviation space for Project Maverick, probably in a manufacturing of parts capacity, someone who's been CEO before, hopefully of a private equity backed platform, right? And this is all like part of the little food chain or totem pole that we're playing in. The ideal situation is you can go pay a headhunter real money to hire a CEO who's going to get $400,000 a year to lead your platform. That will probably work better and be more sustainable over time, right? And that's just actually not possible if your business only has $1 or $2 million of EBITDA, right? So you really just do need to be playing in a higher level to have all those things. But that's where we've seen or experienced the better outcomes. personally, right, from our experience. So yeah, I would say, if an independent sponsor came and said, I'm going to be the CEO of this business, that to me doesn't make a ton of sense unless it's a real special case and it's very obvious that this person is capable of growing a platform because they've done it before and they don't intend to do other deals, right? Generally, an independent sponsor wants to do more than one deal. And obviously, you cannot be the CEO of one of your companies and also the CEO of a different company, right? We're not all Elon Musk. It's not going to work.
The scalability of the independent sponsor model itself, speak to that a little bit in your own experience, Trinity's own experience there, because as I said at the top, you all started as sponsors and have now evolved into the model you have. Why did that evolution occur?
Yeah, I think the critical part was twofold. One is that we did have a competitive advantage when it came to raising the equity, right? It's actually something that we were better at than a baseline, right? Or pretty much anyone else that I've come across in the style that we do it, right? I couldn't sit up there and say we're better at sourcing deals or negotiating proprietary arrangements with entrepreneurs or creating value at the board level, right? I think we were adequate at those things, but I couldn't say we were better. We were better at raising the money. So, classic kind of strategy there is focus on what you do best, right? Additionally, right, in my opinion, the least scalable part of this whole ecosystem we're talking about is sourcing the deals, right? And these independent sponsors who might be part of your audience are knowing that firsthand, right? I have to just carry water across the desert for 1 or 2 years before I find something that's going to stick. And I take a lot of risk. And I have a bunch of sweat equity that goes poof when a deal dies, or actual dollars that could go poof. So it's really, really hard to source that deal and get it done. And so what Trinity is able to do is, we can do 4 platforms, 5 platforms a year, right? Because we have a network of independent sponsors bringing us deals and, pitching them. And they've usually done a whole bunch of work before that step, right? This is not something they came across last Thursday. They frequently have been involved in some way, shape, or form for 6 months or maybe more, 9 months on a specific opportunity before they're coming to pitch it to us. And then we get to sit there like the guys on Shark Tank and say, well, okay, we've got like 8 independent sponsors pitching us deals that they've all worked super hard on, right? And they're all really excited about. And so now we get to pick the one that we like the best. So that actually improved the scalability of our operating company, platforms that we have.
Mm-hmm.
Is there a way a sponsor could become more scalable?
The way to grow an independent sponsor platform, in my opinion, is through really high quality people. So you're going to need to be comfortable with adding overhead, right? You're going to need to be at least having 3 or 4 key partners, and you're going to need to do a couple deals until you have a management fee stream. And instead of pocketing the management fee stream, you're going to need to start reinvesting in your business, right? So you're going to need to become an entrepreneur who's working on growing an independent sponsor business and not afraid to reinvest. If you want to do that, right? There's nothing wrong necessarily with being what I would call just a deal shop, which is usually a collection of 2 or 3 people who get together and do deals. And then, they do several and then they're tapped out because they just don't have the capacity. And then when one sells, they can do another one, right? That would be a deal shop. If you want to grow and be more sustainable, you're going to have to get really comfortable with adding overhead and people and reinvesting.
But in adding overhead, Jay, the conventional thing to do if you're a successful sponsor is to hire someone pretty junior, a 29-year-old associate, and they can do some of the legwork, they can do some of the outbound. But that actually still leaves all the negotiation and relationship building with business owners to you. So what I'm actually hearing between the lines here is you need to hire or have partners, and having senior personnel is how you really get more deals done and expand your capacity.
Yeah. Again, Trinity won't work with someone that's just a one-man band, right? It doesn't make sense. You have too much key person risk, and there's just literally no way to be in 2 or 3 places at once. So anytime I'm speaking with someone that, is trying to get started, the answer is go find a partner or 3, right? So that you have more critical mass to divide and conquer some of these things, and then make sure they have, complementary skill sets. With this particular emphasis actually on the people side of the business, actually. I think the talent acquisition, corporate executive recruiting, getting the right people in the right seats is actually a super important skill in this world. And that's mostly at the management company level, right? The independent sponsor is going to be installing a CEO, hiring and firing a CFO, building out the management teams at these platforms. That's how they're going to grow. And if that's something that you can get really good at, that's a valuable skill. But it's not something that necessarily every private equity or deal guy has in their playbook.
You've been around for a while. How is life for an independent sponsor in 2025 compared to how it was in, call it 2017?
I think generally it would be easier in certain respects in that the term independent sponsor is more mainstream. It's going to be easier to get deals done, I think, generally, right? You're not totally the redheaded stepchild of the buyer universe at this point, where every banker is going to steer a buyer away because you're not capitalized, right? There have been enough progress over the last 8 to 10 years to mute some of that. That said, I think it is a more competitive world, right? There's the McGuire Woods conference stirring the pot, and to some extent, everybody and their brother thinks they can be an independent sponsor. There's literally no barriers to entry of any kind. So it's going to be a crowded universe to bid on deals, and the idea that you're going to just cold call and kind of win a proprietary deal and pay 5 times for something that's worth 8 times, I don't think that happens very much anymore. But maybe.
Earlier in the conversation here, you mentioned an attribution analysis, which that piqued my interest. I would love to hear a little bit more about that.
So I think the reference to an attribution analysis was involving the diligence that we would do on prospective partners, right? This is a sponsor that has a deal. They're potentially interested in Trinity's equity, and we're underwriting them and we're underwriting the business, right? Both are equally important. And we would ask our prospective partner for a track record, right? Show me something that you've done in this world that will instill confidence, right? Whether you've done 5 LBOs and they've all gone full cycle and here's my realized track record, or, I haven't gone full cycle on 5 deals. I've got 1 deal in my portfolio, but I've grown the EBITDA from 5 million to 8 million in 3 years. So, the equity has been marked up. That's great to hear, but we're going to validate that to the greatest extent possible, right? And for me, sometimes what that really means is reference checks. So connect me to your other equity investors, connect me to the lenders who have participated in these other deals. And I'm going to hear from them how you, Mr. Sponsor, were instrumental in the value creation that has occurred, right? Or did you just buy rights? Did you just get lucky? Were you actually not a central pillar in this investment? And instead someone else was driving the bus and you were sort of along for the ride, right? We're going to try to smoke out those things and understand whether or not the value that was created was something that you did, that you sort of get credit for or not. And, if you just bought right and then the market changed and whatever you bought started trading for 10 times and you paid 5, that's still good, right? You still get some credit for that, but we're going to want to understand if you actually know how to replicate some version of that again in the future, or if you were just along for the ride.
Yeah, it reminds me a little bit of last year when the Bain private equity annual report came out. There was a slide in there that analyzed, where is the value creation coming from? And there are 3 categories. And it says, is it coming from operational improvements? Is it coming from multiple expansion, or is it coming from inorganic? And essentially saying all growth in EV has to come from these 3 sources for private equity investments. And then it looked at the world of private equity for the last decade, and it concluded that 50% of value creation actually has come from inorganic efforts. 50% has come from multiple expansion, which leaves all of 0% coming from operational improvements. So that was really striking, effectively saying that all of value creation that has happened in large cap private equity in the last decade has come from not creating value through operations, which is what they say they're going to do. Does that resonate? And is that kind of what you're talking about here?
It does. And yes, that's analogous to what we're talking about. That's true large cap private equity, where I do think it is difficult to create value by just improving operations, right? Generally, what we're talking about here is lower middle market private equity, where there is generally more opportunity to just go transform a business, right? Most of what we're buying is founder owned and run, right? We're not generally buying from another financial sponsor. And this is not to kick dirt on entrepreneurs, right? They create tons of value. They're scrappy. They're awesome. They build fantastic businesses, but usually there's some tipping point where to professionalize the sales force and to add an ERP and to go to multi-locations and to get into adjacent categories, they're just not ready to do that, right? And they're not ready to bet the house on doing that, right? So you can find situations like that where professional ownership, private equity ownership can come in and help with those things. I view that to be actual operational performance improvements, right? That said, I still think in any category, a significant percentage of your value creation is going to come from some version of multiple expansion, which means you're either buying at the right part of the cycle, or you're buying in something where it's just the multiples are going to drift upward forever for some reason. Or potentially, right? What if you grew a business from 5 million of EBITDA to 10 million? Well, even if it's inorganic, right? Acquisitions, generally things with more EBITDA will trade at a higher multiple, right? So you can sort of get credit for multiple expansion in that way as well. But those are key inputs for sure. And so I do recommend that independent sponsors try to be setting themselves up for a situation where they're going to benefit from multiple expansion on the exit, which generally means that you can't overpay on the way in.
The example project or example deal that you shared with us, Project Maverick, Jay, was 40 million of equity. But you said that that's on the large side for any independent sponsor deal, including those that you do. But what's kind of the typical for Trinity, if you will?
Yeah, typical, just down the fairway, let's call it like a $50 to $60 million enterprise value. So, total equity requirement is roughly half of that, maybe a little bit less. So 25 million in total equity. Usually, right, if there's a 25 million gross equity requirement, there's going to be a seller role of some kind. So maybe the seller is rolling $4 million or something into your new company. There might be the co-investment from the sponsor. So that could be 2 million. Your lender, usually, depending on who you're working with, will want an equity co-investment. So that could be a couple $1 million. Then Trinity would just solve for the rest, which in this example is probably that $18 to $20 million. That's kind of right down our strike zone.
Jay, was there anything that you wanted to share with the audience, talking to directly to independent sponsors here, that we didn't hit on? We've covered a lot, but want to give you the chance if we've missed something.
No, I think we covered a lot of the basics, right? I would just try to leave everyone with the idea that, it's going to be hard to grow an organization as an independent sponsor, but that's normal. Everything is hard. Nothing is easy. You should be prepared to work very hard. And so, while it may seem overwhelming at this point, there's a lot of resources out there. There's a lot of sources for debt and equity. And ultimately, it's about doing good deals with good people. And that's something that you can actually control. So I would keep that in mind. And obviously, be sure to reach out to us here at Trinity. If you've got questions, absolutely make my details available. People can reach out, look me up, and happy to field inbounds and generally kind of just help the independent sponsor community, because that's certainly something that we care about.
Fantastic. Jay Fuquay, thank you for your time. Thanks for coming on Meeting of the Minds. We really appreciate it.
All right. Thanks, guys. Look forward to chatting again sometime soon.
Hope you enjoyed that interview. For more like it, subscribe to Meeting of the Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraisers. See you in the next episode.